So feel free to hit the chat box as much as you want. This is for y'all, so I want to make sure I'm giving you the content that you want. But at the same time, I was trying to figure out exactly how to set this up so that, I know that we have Freddie Mac, KPs on this transaction down to people that don't have any properties yet. And so I just want to make sure that, this kind of works for everyone. And, again, be kind. It's my first time doing this. I'm going to go ahead and hit my share screen so that y'all can start to see my little presentation. If you have any questions, feel free to hit them in the chat box now, or we'll clearly have some time for question and answers at the end. All right.
And let me just jump in here, since I did it again. I didn't hit the record button, and say that this is the Real Estate Investment Education Club at Intel. The date is July 23rd, 2021, and our guest is Edward Gray.
Thank you, sir.
And I can watch the chat room for you, so you don't have to. You can concentrate on your speech, and I'll bring the questions up as they come in.
Cool. All right. So again, this is kind of like a basic real estate capital markets presentation. It should be fairly straightforward. So first question is, how do you finance anything, right? The two ways are generally debt and equity. The debt piece is, generally the largest piece by a large margin. Most of our transactions, are, 4 pieces debt, 1 piece equity, 80% loan to value. How most of them are kind of structured. And so, the debt investor, is the priority lien. The equity gets everything left over after the debt's been satisfied. And, most of these transactions we're expecting to have a lot left over. So that's kind of the thought process. So, why would you want to borrow money? It's kind of a simple question, but sometimes you would borrow money if you don't have enough. And the other reason is to increase return. The two simplest of thoughts on why we would borrow. So if you had a property that was $100 that provided 10% in cash flow, it'd be a 10% return. Pretty straightforward math. But instead, if you were to place 80% debt at 8% on it and $20 in equity, your return jumps to an 18% return, which is 80% more in return. So it's kind of the really attractive to really bump the return, and you get an awful lot for it. But when we use leverage, we magnify risk. By far, debt-based transactions are dramatically more risky than a transaction that is 100% funded with equity. That sounds, elementary to say that, but some people just don't think about that portion of it. And so if you have, your cash flow go from, $10 to $8, your return would drop to 8%. Whereas if it's moved to 12, the way we would hope, your return would jump to 28%. And so that's what gets magnified by the leverage. And that brings the next question is, how much debt do we want on a transaction? Many lenders adjust the rate of their interest, their interest rate based upon the amount of debt placed into a deal. And so, a deal at 75 or 80% will have a higher interest rate than one at 65% or one at 55%. So it's, one of those things you have to think through in your own is, how is my business plan going to be affected by debt? So how much do I want to borrow? All right. So kind of, what is the mortgage, right? That is what I offer is, I offer mortgages. They are, the legal instrument which, controls the property. And so you can have, a first mortgage, or a junior, second or third lien. Lien position is obviously one of the most important parts in mortgage lending. That's why we have title insurance. And we generally want to make sure, not generally, we always make sure we're in a first lien position unless we're making a mezzanine loan, in which case we generally will have the first and the mezzanine position, the second position. I assume I haven't seen anything pop up in the chat box, and everyone's kind of grasping this so far. It's kind of the next thing I want to talk about is, who are the lenders that you have? These are just the basicest of lenders. Credit unions, it's a nonprofit group, generally going to be offering short-term loans, a 3 or a 5 year product, and they're generally going to be full recourse. Credit unions are a fantastic place to borrow because their loans have no prepayment penalty. And so, I'm sure we'll talk about prepayment penalties later, but it's a great aspect about them. The next group that you see are commercial banks, which are obviously for profit. Again, they offer generally shorter term loans, 3s and 5s. Some will go to 10. They're again funding based upon deposits, whether it's a cash deposit in your checking account, savings account, or a certificate of deposit. But they again fund via deposits. The next one when we switch to long-term lenders is the life insurance company. And this is where it starts to get interesting. If you have a life insurance policy, you're thinking, what does your monthly premium go to? So that premium, if you're, 40 years old and they expect you to live to 80, they're making investments of your premium money based upon a 40-year life. And so they can do much longer transactions. And they're going to be the first of our lenders that are non-recourse. And what recourse is, I don't think I didn't say it. It has to do if a transaction goes bad, whether they come after your personal assets or just take the asset that you lent on. That they lent on. So it's something to keep in mind.
I want to stop you there and do a full stop on recourse versus non-recourse, because this was a key topic that I learned about. And maybe you could just elaborate a little bit more on why you would want a non-recourse loan.
Sure. So again, a non-recourse loan means that if something goes wrong with the transaction, nothing comes to you or your personal assets. The only thing that gets taken away from you is the LLC, which owns the property. And so they don't come after your car, they don't come after your house, they don't come after your retirement accounts, they don't come after your personal checking account. You just simply hand back the keys, the property's gone, all is forgiven. And we generally see that, life cos, agencies, Wall Street type lenders. The Main Street lenders, the credit unions, the commercial banks, they're what we call recourse lenders. And if you borrow $1 million to buy an apartment complex, and that apartment complex for some reason goes into foreclosure, and they lose their $1 million, they're going to be coming after your personal assets, to make up for the money that they lost. And so there's a huge difference in the risk profile. One puts your personal assets at risk, and the other one is only the assets that you put into the transaction.
Yeah. Why would a bank, want to give a loan where they don't have access to your personal assets?
That's a great question. I don't know why we do it. No, it's the general thought is that you make more and more sophisticated transactions to more and more sophisticated people, especially to groups that may not necessarily be investing their own money, like a fund or something along those lines. The only way they'll do those deals is if they're non-recourse. And historically, non-recourse loans had higher interest rates than recourse loans. But over the course of just my career over the last 20 years, we've seen the rates often on non-recourse loans being lower than the interest rates on recourse loans, which is kind of an interesting thing to think about, that that risk is being priced lower.
And tell me if I'm interrupting too much. Sometimes I try to make it more of a conversation.
No,
but I also don't want to interrupt your flow too. But I was going to say that one of the aha moments for me with non-recourse lending was that non-recourse lending was the difference between a deal that uses recourse and non-recourse is that recourse loans are usually smaller, and they're personal loans. They're for a personal house or maybe a small multifamily, whereas non-recourse tends to be more business. And the way they underwrite the non-recourse loan too is it's based on the income the property produces, whereas a recourse loan, that may not be the case. So it's a difference between running your property as a business, and the bank would go after your business rather than your personal assets.
Yeah, good way to look at it. All right, so The next, capital source for apartment lending, the GSEs, Fannie Mae and Freddie Mac. That is the vast majority of my business is Fannie Mae and Freddie Mac loans. They issue short and long-term agency bonds, generally have absolutely fantastic rates. And, they have an implicit backing of the government, as we saw, they're both in conservatorship right now. And so the government, has backstopped them in the past. And so that's why investors love their bonds. The next group up is HUD. Greystone's HUD's #1 lender. We've been that way for several years. HUD has generally the kind of the longest term loans at 35 years or 40 years, 40 years for new construction and 35 years on a refinance. And so that's really neat because it's a fully amortizing loan versus the other loans we've seen before, generally have shorter terms, and so they aren't fully amortizing. So you'll have to have multiple loans over the course of a time if you were to pay a property off to zero. My other favorite is CMBS bonds. We do a good amount of CMBS properties, and generally we find that deals that are going to go CMBS are ones that didn't make sense for agency. There was some issue about sponsor experience or location. We recently did a CMBS loan for a first-time borrower in a secondary market, and our CMBS team had no problem doing that deal. Rate was probably 40 basis points higher than a Freddie Mac rate, but it was still lower than the Fannie Mae rate at the time. So it's just kind of an interesting thing to think about. Any questions on the various capital partners before I move on to the next page?
Hey, you mentioned CMBS loans. Can you really quickly give us a definition of what that is?
Yeah, I don't know. So it's a loan like anything else. You write a loan, except rather than the loan being held by the life insurance company where you call your account rep, or a bank where you call your account rep. In a CMBS loan, they'll take your loan and say 100 other loans, package them together into a giant trust. They will sell all those bonds in the trust to different investors, and they'll break down the trust by risk pieces. And so some group will only want to buy the least risky asset, generally the AAA, the AA, and the single A. And then other groups will buy the triple B and then below investment grade stuff. And so it's it's a really neat world of its own investors, and they're able to do things sometimes that others aren't able to, because it's kind of dependent upon, do we think we have an investor that will buy these bonds based upon doing something new. Does that kind of get us going in the right direction? Anything else you want to know about CMBS, Daniel?
No, I think that covers it. I think it's one of these situations where I'm familiar with a lot of these terms, but I'm not sure that everybody else is. So if there's a term that you need to have defined, just put it in the chat and let us know.
Okay. One additional thing about, as we talked briefly about prepayment, is CMBS bonds use defeasance as a prepayment mechanism, whereas life insurance companies and GSEs use yield maintenance. HUD uses a simple step down like 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Commercial banks can do whatever they want. Generally, it's a step down. And then, as I said, credit unions don't have a prepayment penalty. And Anita's question is, how do we know which loan is best? We have to look at each transaction kind of on its merits. Again, one loan may be perfect for one owner and it's awful for the next owner on the same exact property based upon their business plan. And so, it's some analysis on your part, where your mortgage, work with your mortgage broker to help figure out, which one is the best based upon what you're trying to achieve. And you may actually have multiple options at any given time that could all, quote unquote, being the best, depending upon what you think you're going to be doing in the future. And so that's kind of the next part, underwriting. Depending upon who you're borrowing from is how underwriting looks. And so underwriting can be just completely different based upon each capital source. For Fannie and Freddie, we have a rule book, it's thousands of pages or whatever, describing how we react to each situation, and we have to apply the exact rule book. Conduit loans, CMBS loans, have RIMIC law, which they have to apply to, whereas, bridge lenders, banks, credit unions, the portfolio lenders who are lending their own money generally have no rule book they have to apply to. And so they can kind of do whatever they want and be much more flexible to create, a bespoke loan for you so that you're able to get exactly what you want, given what you're trying to accomplish. But each one has some trade-offs, and that's, again, kind of back to Nita said, is, which one do you want the most? Often whenever I sit with these groups, someone will talk to their friends and they'll describe a loan to me that doesn't actually exist. They took, the best part of 4 or 5 different loans and are trying to get me to make that loan. I'm like, well, no, you're describing, HUD, with some of the best parts of, agency. And it's kind of an interesting thing is you're trying to figure out, like, what do you need for your business plan? All right. And so there's, I'm going to say 3 main types of loans. Construction loans, or loans used to build buildings. Usually in the affordable space, we'll see loans that have, takeout commitments already attached, but most loans these days are not built with a takeout loan attached. Sometimes a mortgage broker will come to me and ask us to, write a proposal for something that's going to happen 3 years in the future, and we will, and they'll shove it in the file and give it to the banker. Permanent loans are the loans that generally take a loan out of its construction phase. So they can either be, acquisition or refinance. So a takeout loan is the loan that takes out a construction loan. It's, the permanent loan is the other word for it. And it can be either, for acquisitions or refinances. The next part would be the bridge loan, which is, if your construction, project did not get stable quick enough and you're unable to arrange for a permanent takeout loan, you would use a bridge loan to take you out. Bridge loans, by definition, I think about like what a bridge physically is. It links 2 places together. And so, the bridge is to, to bring you from point A to point B on the property's performance curve. Right now, bridge lenders are incredibly aggressive. And so we'll often see people trying to buy a property that, is at market performance and there's nothing you can do to it. And they're going to try and buy up a bridge loan to take advantage of the low interest rates that some bridge lenders are offering. So it's kind of been interesting to see that.
I can give a good example or relate a story about bridge loans. In value add multifamily properties, we often do bridge loans. And the reason why is that Fannie Mae and Freddie Mac usually won't fund you if your occupancy is lower than 90%. And so one of the ways you can boost that occupancy is to take out a temporary bridge loan, and that just gives you the funds in order to do your renovations and to boost your occupancy until you get to that 90% point. And then once you get to that 90% point, you're looking at a permanent loan that comes from Fannie Mae or Freddie Mac, which is usually lower cost. And so if you find a property, for instance, that isn't fully occupied, bridge loan is a fairly common way in order to get that over to a point where you can get a permanent loan.
Yeah, and that's exactly it. You're bridging from point A to point B, the lower occupancy to higher occupancy, the lower income to higher income. So that's kind of the thought there. With the construction, what happens to the properties? It holds collateral. Yes, when a property has a construction loan on it, it has a lien placed on it, just like anything else, it is held as collateral. And if you think about it, the construction lender doesn't advance all the money on day one. There'll be multiple construction draws, some pre-construction money, some money once the foundations are poured, some money once the frames are up, some money once it's closed in various pieces so that they don't, overly give, for an under-collateralized loan that have too much money out at any one time. Yes, correct, Glenn. So bridge loans typically have shorter durations and higher rates. So depending on occupancy, this may or may not be a good idea. Correct. Bridge loans with a shorter duration, can have an issue. And that's always the thing that you fear, is that you're in the middle of your project and, the Great Recession hits and your loan has a maturity default and your bridge lender calls your loan and they take your properties, you're unable to refinance them out. Think about, during COVID, there was some coverage because the courthouse is closed, but people had loans coming due, during the last year during COVID, and were unable to get their properties refinanced. So it's just one of those things that gets scarier, when you have the shorter, duration bridge loans is, how does a hiccup, impact us negatively? And, on a bridge loan, the hiccup can hit you harder and quicker because of the shorter duration. You don't have the amortization on the loan, and it's just a shorter term deal.
I have a question here. You mentioned the word defeasance a little bit earlier, and I was wondering if you could go ahead and define that.
Sure. So in defeasance, again, it's something that really only applies with CMBS loans. When you pay off a loan early in a CMBS loan, you owe them a penalty. And the way they deal with that penalty is through a process called defeasance. In defeasance, you go and buy U.S. government treasuries maturing in each month out into the maturity date of your loan in a dollar amount equal to the payment owed. And so, if you owed, $1 million in payments over the next year, you would buy $1 million in treasury bonds and deposit them with your lender, and you pay it down. And so that can be an absolutely huge penalty when rates have gone lower. At can be 30 or 40% of the loan balance to pay off those loans early. So that's where it's really important to figure out, what loan do you want? Do you want a permanent loan, or do you really want a bridge loan? Because we'll often see someone with a 3-year business plan coming to borrow 10-year money from us. And, do you really want a 3-year loan if you have a 10-year loan, you have a 3-year business plan? And so that's when, the bridge loan does make more sense, is to make sure that you're matching your loan to your business plan. If you're coming in and buying an apartment complex at 60% occupancy, and your thought is that, we'll sell it, in 3 years once it's, at 95% occupancy and stable, you don't really want a 10-year loan. You really do want a bridge loan. And so that, I guess goes back to Nita's question about which loan is best. On any given day, any loan can be best. You have to think through about what your business plan is.
Yeah, you really got to look at those prepayment penalties, and I'll back that up to a question about yield maintenance as well, because that's a similar topic.
Yeah, so yield maintenance is your defeasance's cousin. Rather than handing over treasury bonds, in defeasance, you literally are handing over a giant single cash payment, where you're making the net present value of the payments left versus today equal to 0. And so, if you're prepaying a loan when the interest rate, is so low as it is today, the reinvestment rate's low. And so the difference between, just imagine a 4% treasury and a 1% treasury is 3% discounted back over, 50 or 60 payments. It can be a very large number. Defeasance and yield maintenance are not the easiest of concepts to, understand. But they really are set up so that the lender, can be induced to making you a longer term loan and feeling comfortable doing so. It takes away kind of the optionality that you have to just prepay them at any time. It's a little bit, different thought process. I don't know if I'm doing the best job of explaining yield maintenance or defeasance, but it's kind of the number that makes the lender whole, so they don't care if you repay them.
Yeah, and I would even add to that it is a little bit of a different mindset, because with a residential loan, obviously you can pay it off at any time. You can go pay your home off if you have the cash, and banks are glad to do that. But when you start talking about commercial loans, banks are in the business. I mean, their main business is lending money out, and they want to see that money lent out and not always coming back to them. And so these are ways of guaranteeing that they keep their money out, and if the loan comes back early, there's a penalty.
Yeah. I mean, it's somewhat comical that if you think about the bond traders that trade residential mortgage-backed securities, versus the bond traders that trade commercial mortgage-backed securities. The bond traders that do, RMBS are a million times smarter. They're often, PhDs in mathematics, calculating prepayment curves and things of that nature. Whereas, the guys that are doing CMBS deals, it's like, look at the picture. It's a beautiful building. You should buy the loan. That's, being a little facetious, but that's kind of how the difference between the two groups are. All right. So kind of the next kind of thought process is, what do you need to start figuring out how big of a loan you can get? And really kind of like three key items to get going: a rent roll, that operating history, kind of the T12 historical financials, and your budget pro forma for the next year. Kind of the three things we need to kind of get going. So this is kind of what a rent roll looks like. And, it's pretty straightforward. Unit number, name, how they use the term active for whether they've given notice or not, how much is the rent. And so, we see, someone who's just moved in, they still have some discount, the last payment date, move-in date, lease start date, lease end date, the unit type, which is very important for those of us who do agency lending. We use that to calculate affordability. Tells you how big the units are and where they think market rent is, when this unit turns and they lease it to someone else in the future. And so you'll see the very first unit on that one has a lease end date in 2019. So that tenant's what we call month to month. They're just hanging out without a lease and hanging out. Anyone have any questions on a rent roll? It's kind of self-explanatory, but if not, I'll move on to the next page. All right. So the T12 is the next one. And this is where people who, kind of make up their own spreadsheets can drive us nuts because we need it to be in an easy to read format. And so, starting in the upper left corner, you'll have, kind of the income. Beneath that are the main expense categories. And gets down to the net operating income. As you move from left to right, it shows, the prior months, moving to a total at the end. Again, pretty straightforward. Often the issues that we have, with switching from the T12 to the budget pro forma on an acquisition is someone not thinking through what their insurance bill will be on acquisition or what their real estate taxes will be on acquisition, because in many jurisdictions, taxes change when ownership changes. Something to keep in mind. All right, next up, kind of some key concepts, terms. Income, pretty straightforward. It's money that comes in. The expenses are the things that you have to pay. And so when income, minus expenses gets you to your net operating income, you'll see your loan payments referred to as debt service. And so the NOI minus your debt service is cash flow after debt service. Pretty straightforward. Let me just, think about how that kind of falls so that, income minus expenses minus the debt service gets you to the cash flow after debt service. Next up,
Edward,
yes, sir.
What is debt service?
It just means loan payment. Fancy word for loan payment.
It's your mortgage or your loan payment. Yeah.
Yeah. So the next kind of like new word, new concept is cap rate. And so you'll hear people say, what is the cap rate? And the cap rate is the multiple of you apply to the NOI to come up with a value. And so if a property has an NOI of $10 and it has a cap rate of 10%, the property has a value of $100. You'll often hear people use cap rate as a quick way to figure out if they have an interest in a transaction or not. It can be somewhat misleading when you're talking about properties that aren't stabilized. Cap rates are wonderful on stabilized assets, but on properties that, like Daniel's describing earlier, 60% occupied, the cap rate's not telling you much because the cap rate of today, it could be 1 or it could be unpalatable calculated, negative number. Going forward, you'll have that fixed shortly, and the cap rate no longer is applicable. Just keep in mind that's a number you'll often hear referred to as the cap rate. Next up is loan to value. And loan to value is just the mortgage amount divided by the value. Lenders care about it, because we don't want to, ever give out more loan than value in the property. The last thing we want to do is give you $120 on your $100 property. We generally, stop lending at, say, 75 or 80% loan to value. Again, no hard and fast rules depending on the lender, but it's just, one of those things that people are going to be looking at. Next up, debt service coverage ratio, which is your mortgage payments divided by the income, usually referred to as like, you'll hear someone say, I'll make you an 80% LTV loan at a 125 debt service coverage, which means they'll stop lending money at the lower of 80% LTV or a 125 debt service coverage. Next up, debt yield, which is just cap rate to the lender's mortgage position. And so, all right, so we have a question on cap rates. So start thinking through about cap rates. Depending upon the market you're in and the properties you're looking at, cap rates today probably range from 3.25% all the way up to probably about 7% or so. That would be the vast majority of multifamily transactions offered up for sale. Cap rates are incredibly, accurate and valuable to use for looking at assets that are stable. But, as we look at transactions that aren't stable, we would start to care more about, a discounted cash flow and less of a cap rate. And so I often tell people they need to look at kind of, three numbers simultaneously, the cash on cash return, which is very similar to the cap rate, IRR and equity multiple, kind of figure out what they're seeing in the transaction. I don't know if I'm answering what you're looking for on the cap rate. Feel free to poke some more on that one if you want more information.
I would add here also that all of these terms don't necessarily just apply to multifamily, but any sort of asset. If you are going in and you want to buy, a dentist office that has several areas that you can rent out, or if you're buying a strip mall or a dollar store or a mobile home park or a lumber yard, all of these terms apply to any sort of property that is valued based off its income.
100% correct. All right, and so kind of the next one people ask, I give you a quick rundown. So you want to become an agency borrower, what do I have to do? We're generally looking for someone with a net worth equal to the loan amount. So if you want to borrow $1 million, we want you to have a net worth of $1 million. We generally want liquidity equal to, roughly 9 months payments post-closing. So you can't use all of your cash to buy the property. You have to have some money in reserve. Generally want a credit score greater than 700 with no major derogatories, no foreclosures, no bankruptcies, things like that. And the next one's kind of the worst part, not your first deal. We want you to see that you've done, been part of other people's transactions before we give you the reins to, several $1 million. I figured there'd probably be a lot of questions on that slide. Anyone have any questions on that? Yeah, and so typical LTV, 75 or 80%. As you move into, very attractive markets, Dallas, Texas, Denver, Colorado, San Diego, Los Angeles, up to Santa Barbara, San Francisco, Seattle, you may see many of those loans capping out at, 55 or 60% LTV because the values are so high. So LTV, shifts a lot depending upon the property. It's very property specific. All right, so that's kind of the end of my official presentation. Daniel said to have about 20 minutes left for regular stuff.
Okay. Yeah, we had a lot of good terms thrown out there, and I know there's got to be questions out there. Michael is asking, what alternatives are out there for your first deal? And maybe even you mentioned that you have to have a net worth of at least the amount of the loan, but maybe you could describe how you can partner with people in order to satisfy the bank's requirements there.
For sure. Hey, do I have this screen share off, or is that still sharing?
We're seeing your face right now.
Yay! Perfect. All right. Yeah. So the way you see many people start off is they'll either start by investing in houses, rolling to fourplexes, to a small apartment complex, which they finance with a credit union or a bank. And then as they get a little bit bigger, they'll start borrowing from agency lenders or life cos or from CMBS conduits. A credit union or commercial bank, generally has no minimum loan size. And so they're quite happy, lending, $600,000, $700,000 on an 8-unit deal. Agency lenders, we generally start at $1 million. CMBS conduits generally start at, say, $5 million. And so it just kind of varies. There's not really a very easy way to kind of grasp current market values like Zillow for commercial. LoopNet's a great website. Kind of surf LoopNet, see what's being offered out in the market, and kind of get an idea, a taste for transactions. But each apartment complex is valued based upon the individual cash it generates. And so it's not like a house where you can say that if you have a whole row of houses that all look identical, they're probably fairly similar valued. One apartment complex has been fully renovated on the interior and it's able to get 15% higher rents. And so you really have to look at each deal individually, and that's where it becomes really important to focus on key markets. And so when you're getting started, you're only doing deals in city X, and you get to know everyone who's in city X, and you're then able to have a better idea of what somebody should trade for because you're seeing all the trades and you're just keeping kind of a track of that in your mind or on a spreadsheet.
LoopNet's an interesting website to go look at because you'll see a lot of commercial properties there. But it's kind of, I've heard a running joke about it that LoopNet is the graveyard where deals go to die. And the reason why that's often said is because brokers will, of course, contact people that they know first. And if they can't get anybody to buy the deal, then it ends up there. But occasionally you can find a diamond in the rough.
Yeah, I mean, Daniel has a key point. You'll often hear the term off market, and we have a sales team in Houston that I sit with. Our sales team will probably sell 50 deals a year, and of the 50 deals they'll sell in a given year, 35 to 40 of them they'll sell off market, and so they'll only show maybe a total of 6-7 people the transaction.
Okay, Anita has another question. When you bring in partners on an RE deal, does each partner have to have the net worth of the RE that you're buying?
No. And so that's kind of the beauty of the part of the partnership, right? Is that if you're buying $1 million deal and there's 5 partners, each with a net worth of $200,000, we stack the 5 of you together, that equals $1 million, and there you go. So that's part of. Sorry, Dan, go ahead.
Oh, I didn't mean to cut you off.
Yeah, so that's kind of the beauty of partnerships, right? Is that they allow different people with different portions of the deal to come in and work. I mean, imagine a transaction where someone had $1 million in Intel stock, but they had no money because they spend it all, and then someone else that has $250,000 in cash but no additional net worth. You can put those people together, you suddenly have the liquidity that you need, plus on top of that you have the net worth.
Yep.
And so
that actually goes back to Eric's question here about the typical path. A lot of people do start with small houses and work their way up, but some people, if they want to go directly into something larger or, a strip mall or some commercial office type space, they'll partner with somebody who has already done 1 or 2 loans and that the banks already know. And so I think that's typically the on-ramp for people to get into the business. Is you have to find a person who's done it and has the contacts.
Yeah, we see a tremendous number of people who, for lack of saying, they'll be the bird dog. They're out there calling, looking, finding. They'll find a deal. They'll go to someone who's been in the business and say, "Hey, I found this piece of property I'd like to buy. Can I partner with you?" And they partner together, and the one that the more established person reaches out to their lending relationships, like, "Oh, yes, yes, we know you. We're happy to give you money." Uh, and so that's kind of how that works.
Abby Shaw is asking, can you get a long-term loan for investments, i.e. 20 years or longer?
You can't. And so the people that would do that, HUD offers 35 and 40-year loans. Life insurance companies often give you terms out to 30 years. Fannie Mae will give terms out to 30 years. And so just the thing that you have to face as you move out the maturity date of your loan, past the kind of the standard 10-year to a 15, a 20, a 30, is you generally are paying more. It's not as common of a loan, so it's a little bit harder to place. And so you end up paying a few more basis points. Last time I priced a 1030, which is a 10-year loan with a 30-year amortization versus a 3030. And it's a 30-year loan with a 30-year amortization on Fannie Mae. They wanted 80 basis points, so almost a full percent to move to the 3030. That fluctuates by day depending upon what lenders are looking for.
David is asking, what is depreciation term for multifamily or any commercial asset? Is there a standard length of time? Also, does this assume straight line depreciation?
So I am not an expert in depreciation. I believe it's 27 and a half years. But one of the key things about real estate investment that's very much in everyone's interest these days is people get cost segregation studies where they look at a property and depreciate the improvements versus the fixtures and furniture and everything else, which gets you just a different depreciation number of lots of bonus depreciation up front. That's one of those ones that I would say, please talk to a professional.
And we could do cost segregation as a topic of the future too. That's an interesting one to talk about. But the basic idea is your carpet doesn't last 27 and a half years, so it should depreciate faster. And if you have a whole item of those, you can speed up your depreciation.
Yeah.
All right. Any other questions? It's been a whirlwind tour here in commercial loans. All right. I have a question. You've mentioned multifamily a lot, but where do these loans differ for, let's say that you're an Intel employee, but you want to go be a strip mall owner, and you want to have a couple of different stores in this mall. Do any of the loan terms really significantly change from what you've described here when you're doing office or retail?
Yeah. So, through my CMBS platform, we can lend to those things. But when you move out of the multifamily, HUD drops off, Fannie Mae and Freddie Mac drop off. So you've just, lost several of your key lenders. Generally, when you look at commercial assets, strip centers, office buildings, hotels, industrial buildings, you don't get the same loan to value. You will generally find that your, 70 and 65% advances look a lot more common, and the market's less liquid. The government, I generally joke, people don't like we talk about being a mission-based lender, but I'm a mission-based lender. My job is to help the expansion of affordable housing. And so Fannie Mae, Freddie Mac, and HUD, have government backing, which helps to push the interest rates down, which theoretically helps to allow for cheaper housing. You don't have that same government backing for office or retail or hotels, and so you don't get the same same rates or same terms. Those markets stand much more on their own in the commercial space. Right now, the two most attractive types of real estate someone could buy would be, large industrial buildings and multifamily. Amazon can't build buildings fast enough, and investors are doing backflips to buy buildings with Amazon leases on them. Those are by far the two prettiest types of property for investors today are, distribution, logistics, industrial buildings, and multifamily. And, kind of the least attractive buildings for anyone are unanchored retail or, fitness anchored retail. No one wants the shopping center that the gym anchor, or, hotels. Both of them are having very difficult times getting placed, in today's market.
And maybe another scenario too. Let's say that you are an employee and you want to build, a nice house, and you're looking for a construction loan to do that, or maybe you want to build a fourplex or something like that. Would any of these loans come into play if you're doing your own construction?
Yes, I mean, really, the lenders you're going to be looking at when you're doing, building a fourplex or something will be your commercial banks. They are the ones that are in your community and are lending in your community. And generally, for homes and fourplexes, we call residential lending, 1 to 4 units. It will be the commercial bank that does that loan.
All right, Kevin is asking, not sure if it's covered in the earlier topic, is construction loans similar to construction to permanent loans?
They are very different products. So a construction loan is a loan that literally gets your building built, and it does nothing once it's in operations. Construction to perm loans, you generally kind of see coming out of two groups. One, HUD does construction to perm, and then the other one you'll see is life insurance companies doing construction to perm. And so what that means is, once it's done in the construction phase, interest rate generally changes, and then is in a permanent loan for either 10 to 40 years. Construction to perm is a very popular product for people that are developers.
All right, and then Edward, can you give your contact information for anybody who would like to reach out to you?
Sure. Again, my name's Edward Gray. Easiest way to find me is send me a connection request on LinkedIn, or feel free to call me anytime. I'll give you my phone number, 512-587-7566, or my email, which is edward.gray, Gray, at Grayco, which is GREYCO.com. All right, so we got some more questions popping up. So one of the hardest property types, for Daniel to invest in is, the 7-unit apartment complex, because they generally don't have a high enough loan balance to come borrow from Fannie Freddie multifamily. And because they have, 7 or 8 units, they have too many units for Fannie or Freddie residential. That's a super difficult space. And so I kind of always tell people, you either want to be in a fourplex where you can get your residential financing, or you want to be doing a deal with a purchase price of, say, $1.6 million, $1.7 million, so you can get, good, agency multifamily loans.
I would just say it's not hard for me, it's hard for the bank. And then William has, are there interest rates? I didn't mean that to come out quite the way it did. It's not something I do.
I mean, it's the old joke, when you owe the bank $1 million and you're having problems, that's your problem. When you have $100 million at the bank and you're having problems, that's the bank's problem.
Right. Are the interest rates higher during construction loans versus permanent loans?
Generally, they are. Generally, you would see a higher loan during the construction period than for a perm loan. Maybe as much as 2 or 3% higher.
Okay. And before we close it off, are there any other questions? Well, thank you so much, everybody. Could you take yourselves off mute and just say thank you to Edward for coming in and taking his time out of his day to share. And Edward, you did a great job here. This is, I guess you mentioned earlier, this is one of the, you don't tend to talk in front of large groups very often. So thank you very much for coming in and doing that.
No, I appreciate y'all for having me. I'm glad to come support y'all. And if you have any questions in the lending world, again, I'm on LinkedIn, Edward Gray. Reach out to Daniel. He knows how to find me. I literally talk on the phone for a living, so I'm happy to do anything I can to help y'all, learn more.
Thank you.
Great.
Thank you.
Thank you so much.
Thanks a lot.
Thanks, guys.
Thank you.
I'll
Thanks,
drop
Mark.
Edward's LinkedIn in just a moment.
Thanks again.
All right, Daniel.
All right.
Then I'll drop out and, let me know anything else.
Okay. I'm going to drop your LinkedIn into the chat right here and people will get it. I'll also take your presentation and post it internally on our Speakers Hall of Fame so that people can come by and look it up later. A lot of people do that, actually. I'm surprised. I wish people could. I wish we were able to take it and move that outside of Intel so people could turn it into a podcast feed and just consume it that way. But people have to be logged into the Intel network in order to see it. And I just dropped your LinkedIn there.
Cool.
In the chat. Have a great weekend, everybody.
All right. See you.
Thank you.